Kramer, President of Pyle Financial Services. I have with us today our founder and Chief Investment Officer, Scott Pyle. So behind us, you'll notice this is a chart of the S&P 500. We want to talk about a couple of things today relative to performance. So I want to take you back to something you mentioned at the end of last year, right about here. Pain was at a very real level then, and here's what you said. You said the market typically can be irrational longer than investors can be patient.
Yes.
Take us back here.
Well, I think for many people that are investors, they'll remember when we started to fall off this cliff into Christmas Eve.
Yep.
And how painful it was. But we came out and tried to calm everyone and say the emotional, irrational activity in trading was not supported by fundamentals. We expected GDP to grow at 3% year over year, which we've now seen that happen.
Yes.
We also said S&P earnings are double-digit expectations going forward. And this is the chart of the S&P. And the media was talking about a recession here.
That's
and
right.
We were screaming and raising our hands that there was no recession in sign, or the signs of no recession going forward, because the data did not support it. The data supported growth and good market return.
When I heard you tell a client just the other day, if this is a recession, this is the best recession we've ever had.
Yeah.
Okay, so if you're an investor, you're up roughly 24% from the bottom and 15% year to date.
If you're 100% invested in the S&P 500.
Okay, that's right. So if you have the backbone for an all equity portfolio, which most investors don't, where are we now? What's the story up 15?
Well, you think about, as you said, many investors, and we see this all the time, are invested via textbook type allocation.
That's right.
50-50 stocks, bonds, 60-40 stocks, bonds, 70-30. So many people are not fully invested. And we also have sectors that because we are such a sector-focused firm, that are up much more than the S&P, some 20+%.
Sure.
And so here we are, back to all-time highs, setting them again. 1 year's worth of return in what, not even 5 months.
That's right. So we literally have our team right now taking our entire year's profit off the table.
Yeah, we've spent the last week doing that in our firm-wide, across the board. Because think about it, back here, if I'd have told you January 3rd, May 3rd, or November 3rd, you can have an entire year or two's returns in the books, would you take it?
Well, of course.
Yeah, but you prefer January 3rd.
Yeah.
Yeah. But here we are, last week, May 3rd, and we are taking a year's worth of returns or more off the table, because we thought the S&P could go to 3,100. We got up to 2,950 just a few days ago.
All right, so where will we finish the year?
Well, we said at the end of last year, the S&P 500 could hit 3,100. We got to 2,950. We thought the Dow Jones could get to 28,500. And so while we still believe that, here we are so quickly back to those, close to those numbers.
Yeah.
We're taking the profits and looking for more volatility ahead. And we always take profits and hope we're wrong.
Yeah.
And then we just go straight up to those new all-time highs.
Well, it could be, it remains to be seen, the old sell in May go away.
Sure, we could have a very volatile summer. We have the election, the first Democratic
primary debate
will come up, and we're going to see what issues are going to be important to them, and that's going to help dictate investing for the rest of the year.
So if you're an investor and you're only up maybe half the S&P, or you're not sure why your portfolio fell with the market but hasn't recovered, you need to sit down and talk with us. We look forward to hearing from you. Thanks for tuning in.